Hi, y'all. I'm John Rotanti, a portfolio manager at Bastion Fiduciary and one of the hosts of Rebellious Allocations, which is our Bastion Fiduciary podcast. The date is September 11th, 2025. And just saying that date is really hard for me, and I know hard for so many. But today I'm joined by my friend Todd Wenning for part 2 of our stock chats. As a reminder, for part 1, we discussed Old Dominion Freight Line, ticker ODFL. And today, for part 2, we'll be discussing Ferguson, ticker FERG. Todd and I both own Old Dominion and Ferguson in the portfolios we manage. Todd is the founder of KNA Capital Management and the author of the book, Keeping Your Dividend Edge, and the author of the Flyover Stocks newsletter. Prior to founding KNA Capital, Todd was an equity analyst at the Motley Fool, at Vanguard, and at Ensemble Capital. And Todd was also the former head of the equity stewardship framework at Morningstar. While at Morningstar, he contributed to the book, Why Moats Matter. Todd also teaches corporate finance and ESG investing at the University of Dayton. Todd, welcome back to the show.
Thanks, John. Great to be back.
So we're talking Ferguson today, which once again is a stock that I own in the portfolio that I manage at Bastion Fiduciary, and a stock that you own in your client portfolios as well. I'm just going to give a few basic company statistics so listeners get an idea of the size of Ferguson. Ferguson has a market cap of about $44 billion and net debt of about $5.3 billion. So its enterprise value is nearly $50 billion. In the last 12 months, it generated revenue of about $30 billion and net income of about $1.6 billion. To put Ferguson's annual revenue into perspective, here are the numbers for two other leading distributors in the United States. In the last 12 months, Fastenal generated revenue of less than $8 billion, and Grainger generated revenue of about $17.5 billion. Now, Ferguson does not compete too much with Fastenal or Grainger. They sell different products into different end markets, and the three companies have vastly different margin profiles. But I think the top line comparison sets the stage for our chat about a company that is one of the largest distributors in the US. So, Todd, can you give us a brief business description on Ferguson? What does it do? How many different products does it distribute? And to how many customers? How many branches does it have? Those types of things.
It's one of the most diversified companies I can think of when you think about their product lines and what they touch. So Ferguson has about 1,800 branches across the North America, US and Canada. And they have over 36,000 suppliers and over 1 million customers. So they're touching just about every piece of the industrial landscape, right? The best way to describe them from a distribution perspective, because Fastenal's got one niche and Grainger's got another. Thinking about it, to me, it's a value-added distributor with a focus on plumbing and water infrastructure. That's not all they do, but I think that's their specialization. Best way to think about them. And so they primarily sell to the professional customer, with some exceptions. They're currently rebranding a little bit there. So they own Build.com, and they're folding that into what they're calling Ferguson Home. So you might see some stores popping up around your town where they may have some showrooms that you can go into. And typically those are typically appointment only. So you kind of have to bring an interior designer with you or a contractor. It's not like a Home Depot where you can usually pop in and pop out. I'm sure you can, but typically it's with a professional.
I've been to one of those showrooms down here in Louisiana, and they are very nice.
Mm-hmm.
And yes, it was by appointment only. Can you give us a brief history of Ferguson, including the redomiciling to the U.S., the name change, and I think they even had some divestitures of their European business?
Right. So they were founded, I believe, in the 1950s by three men. It's funny because Old Dominion, we talked about being based in Southeast Virginia, and Ferguson takes its roots back to the Norfolk, Virginia area. So there were three guys founded the company. One of them was named Ferguson, and they would kind of do what ODFL did in the beginning, which is just running their own trucks back and forth and just continued to build on that. By the time they got to the early 1980s, it was managed by another person who rebranded the company Ferguson because he liked one of the founders a lot and wanted to honor that person. So I think he ran the company for over a decade, ending in the early 1980s when it was acquired by a UK based company called Wolseley. And for our American listeners, that's a really tough word to say or spell. Wolseley is a UK based company trying to do roughly the same thing, but in the UK and Europe. And what ended up happening over time was Ferguson in the US used the capital that Wolseley was able to provide it to expand from, 50, I think it had 50 locations when it was acquired to over 1,700 by the time it redomiciled. And so by the mid 2010s, the North American business had dwarfed the UK and European business. It was primarily a North American company by that point anyway. The US investors or US consumers, US customers knew it as Ferguson the whole time. So it was never rebranded as Wolseley. And so the company in 2017 changed its name from Wolseley to Ferguson. It was still based in the UK. And around 2019, 2020, they decided they were going to redomicile back to the US and move their primary listing from the London market to the NYSE.
I believe hedge fund manager Nelson Peltz's firm owns over $200 million of stock in Ferguson. What role did Nelson Peltz play in the Ferguson story?
So Nelson Peltz, he came in initially sort of as a nudge, as they were already kind of talking about redomiciling to the US and changing their name, and just kind of gave them a push to do that and to change management. So that's when the new CEO came in, Kevin Murphy, in 2019. It was right around the time that Peltz got involved. And so I think he just kind of gave them a nudge to say, hey, if you if you move to the US, your multiples will improve. You've got better brand recognition. Investors will understand what your company is selling at that point, and then potentially get listed in the S&P 500, which would be potentially a tailwind for your stock price. They're still not on the S&P 500, incidentally, but it's sort of inevitable at this point. So I think that was primarily what Peltz did. And I believe he sold a bunch of it in earlier this year, but then he bought it back again in April, if I understand correctly. I could be wrong, but I believe there was a sale and then a purchase, a buyback when the stock sold off during the tariff concerns.
Yeah. Yeah. You mentioned HVAC and water. Can you give us a breakdown of the end markets it sells into, and then a breakdown of, residential versus non-residential exposure and things like that?
So it's about 60-40 non-residential to residential. I'm sorry, residential to non-residential. And then inside of that, repair and maintenance and remodel is about 60% of revenue. And then new construction's 40%. So again, going back to their end markets and their business model, it's just very balanced.
Yes.
Is the right way to think about it. They're not super focused on just one niche or another. So waterworks, for example, is something they do, right? And that's where you have large scale projects where they're putting pipes for new construction into the ground for the first time, or they're pulling out old pipes and putting in new pipes in the municipal kind of domain. Could be large construction projects as well. So if you're building a new community out in a rural area that's never had any sort of plumbing done, infrastructure, they can come in and do that. That's part of their business. So HVAC is also part of their business as well. And we'll talk about that in a little bit with their dual counter strategy. But they also serve the everyday plumber with residential plumbing needs. If you're working on my house and my bathroom needs to be remodeled, or there's a repair that needs to be done, they specialize in having all the plumbing SKUs. And that's one of their advantages that they offer, is having just a ton of SKUs, whereas Home Depot may not have a specific SKU, and you might have to wait around for that part, whereas Ferguson will likely have it on hand. So they stretch it pretty far. I mean, going all the way from HVAC to residential plumbing, to commercial plumbing, to fire prevention. It runs the gamut. And again, all of it kind of touches on water. Even HVAC has similarities to plumbing, although the end user may be a little bit different in places. It does rhyme with it. They do rhyme with each other.
They definitely rhyme. Yeah. Can you give us a quick overview of the competitive landscape? What are Ferguson's market shares in these different end markets? Who is it competing against? And how fragmented or consolidated are Ferguson's end markets?
Ferguson competes against some big players, but in different places of their business. Again, it's sort of this part of their advantage is that they're not going head to head in all parts of their business with any one competitor. So in Waterworks, for example, they're the number one provider, but they're competing against Core and Main, which is another large waterworks producer. So that's where they compete against them. And so that's the former HD Supply Waterworks business. And then they're also competing, obviously, with Home Depot and Lowe's when it comes to more kind of closer to the consumer. They're competing with some of the like Watsco in HVAC. So they're competing against some big players in different parts of their business. But again, no single subsegment of their U.S. business accounts for more than 25% of sales. So it's a very diversified business. So within those categories, it's a pretty the markets remain pretty fragmented. If you think about your town, if you drive around your town or your zip code, there's probably going to be some kind of plumbing distributor there, right? So there's a lot of mom and pop independents that are still around. I tend to take some of these market share projections with a grain of salt. So they say that 75% of their revenue comes from markets in which they're the number one or number two market share, which I completely agree with. They think that they've only captured about 10% of their total addressable market. And that's where I think it's possible. But I also think I think companies tend to overstate their total addressable market because that might be the total addressable market, but what's the realistic addressable market? It's sort of like a Major League Baseball player saying, I've got a huge opportunity in the minor leagues. Yeah, but you wouldn't want to play there. So I do think you take that with a little bit of grain of salt, but even if you cut that market total in half, they still have a long runway to do acquisitions, to take share, and that's a big part of their growth strategy as well, to take share over time from some of the smaller independents.
Yeah. Number one or number two player in most of their markets, but still fragmented enough that there's a long runway to grow organically and through M&A, through consolidation.
Yes, I believe they have their largest market share that they say is about 25%. So they're not in any like old rational oligopolies
Right.
that you might see in other distribution centers.
Yeah. Yeah. Um, is there anything we need to know about the industry? Were there any big inflection points, any big consolidation cycles, or are there any secular tailwinds driving this industry?
Yeah, I think for a long time, water infrastructure has been neglected in the US. I think the
Underinvested in.
underinvested in.
Yeah.
Yeah, for sure. I think if you look at municipalities, some of the statistics that I can't recall necessarily off the top of my head are pretty dire. You think about, I think the average municipal pipe is like 75 years old,
Yeah.
something like that. It's a very old infrastructure, and we've taken water for granted for a very long time. Just sort of a cheap, abundant commodity, and depending on where you live in the country, that's no longer the case. And then you have aging infrastructure. The pipes that were put in back, post World War II are starting to crack. And I don't know about what it's like where you live, but I live in a town in near Cincinnati that's 3 mile by 1 mile, and I get text messages all the time from the city saying, "Hey, water main break, don't go down this road." And so it's a constant issue where they're trying to keep up with all this aging infrastructure. Then you think about new homes being built. Constantly need new plumbing. I mean, I have an older house, constantly needs new plumbing. Water is regularly used in our homes, and things wear down over time. If you want to remodel your kitchen, all that plumbing has to get done. So that's a big part of their tailwind. And of course, HVAC is going to be increasingly important over time. It's just going to be a very strong recurring revenue model when you think about how dependent we are on HVAC, both in the winter and in the summer months, and how the replacement cycles for those are 10 to 12 years. So they always need to be worked on and upgraded.
Yeah, which brings me to my next question. So plumbing and HVAC, two attractive industries, crucial in nature, absolutely crucial. So let's talk about, Ferguson has this business model right now, or this business strategy which are called like counter conversions. And they are trying to convert their branches from single trade counters to dual trade counters. So please explain what a counter conversion is and tell us how many counter conversions they've already completed and why are they doing these counter conversions?
So there's some interesting things happening in the contractor space. If there's a lot of private equity coming in and buying up independent contractors, plumbers, HVAC repairs, and often they're combining those. So if rather than have an HVAC guy and a plumbing guy, you've got a plumbing guy who can also do HVAC. And so the issue is that if you have customers, let's say you have a Ferguson plumbing store that's close by, but you don't have an HVAC that's close by. Well, that you're losing some of that customer's wallet if they're a dual trade, right? If they're plumbing and HVAC, because they have to go one place or the other, and not they can't go to the same place. And so the idea is that hey, we want to become more of a one-stop shop for these contractors who service both, rather than lose their business potentially because the Ferguson HVAC center is too far away for the jobs that they do. So that's the idea is converting, bringing the SKUs from HVAC into the plumbing locations and vice versa where necessary. So I think they wanted to do over 650. They're pretty far through that process. I think they were about 500 or so done. So they are well into that process. But again, that's the idea, is trying to capture that incremental spend from the contractors who do both plumbing and HVAC.
I've noticed here in Louisiana where I live that contractors that I've used in the past, last 15 or 20 years are now becoming dual contractors. And you can even see their vans and their trucks where they draw a line down the side and says plumbing on one side, HVAC on the other. And so I'm seeing this conversion in real time. Yeah.
Yes.
Do you think Ferguson has a moat? And if so, what are the sources of that moat?
I do think Ferguson has a moat. I think it has a wide moat, and I think that moat is getting wider. And part of the reason that I think it's getting wider is what we just talked about, this consolidation of independent mom and pops and the roll-ups of private equity, the scale of some of the projects that are occurring. Think about data center construction, right? That those are national accounts that are building those major projects. These are not being done by a local contractor. These are being done by Google and Facebook and the national builders they use to build these things. And so they want a national partner.
Yes.
And Ferguson can do everything that needs to be done from a water infrastructure standpoint, from a cooling standpoint. They can take care of the entire process. They can fabricate on site, which is a huge advantage. And so the moat comes from these, their customer relationships, right? That's the key thing, because you need to have those relationships at a store to store level, because that's what matters. So from a local contractor standpoint, those local relationships matter, but increasingly what we're seeing are the national relationships, and the national relationships so mattering. So if you're an upstart water distribution company, it's very difficult to win the business of a national account, because the time is money, right? If you are waiting for a part to get there, if things are done correctly, that's costing you money. And having a reliable partner like Ferguson to do the work necessary just saves you a lot of money. And so so then you have the spread between the price you're paying for Ferguson's products and the value that it's delivering to you.
Love that. Music to my ears. Moat that is wide, that you think is getting wider. I would agree. Todd, you have written that, quote, distribution done well is intrinsically durable, end quote. Why do you believe that? And what does it mean? What makes it intrinsically durable in your opinion?
So I've told the story where I was having ice cream with my family at a local shop that just opened a couple of years ago. And I look over and there's this nondescript red brick building sitting next to the ice cream shop. And it was a roofing distribution business, and it was in business since I think it was 1875. I thought, that's incredible. 150 years this business has been in operation, and they're selling roofing products. They're distributing roofing products. And I looked into it a little bit more, and it's a multi-generational family running it. And I thought, that made me think, this is a really durable business model. I had covered Fastenal, I had covered the Granger, I'd covered the distribution businesses in the past, but it never really hit me how durable this business model is. And if you go around your town, again, through your zip code or your county, I guarantee you there's a mom and pop distributor that's been around for probably 90 to 100 years that's been doing this. And it got me thinking, why is this intrinsically durable? First, it has to be done well. First, obviously, you have to be good at what you're doing. And that is delivering on time, establishing that trust with your customers. And so I think that's the key, right? If you do those things, you win the trust of your customers, and they've got big projects and they've got a time schedule and they've got to get things done on time. And if you can prove yourself from a distribution standpoint that you can bring the products when you'll have the products when they want them, you can deliver them on time,
right,
in stock, and have everything ready, you will keep winning that business. And it's not worth that customer's time or money to shop around for the next one, because the price won't be that different. It's going to be more about the service being provided. And so I think distributors that are able to do that and do it well, have a durable advantage. And even the local, so you think about distribution advantages on the local level, a lot of these, both the contractors and the distribution centers, are multi-generational family. So you have a lot of personal relationships that go back many generations, working together. And so that's another switching cost that I think is intrinsic to or specific to this industry that it's hard to find in mom and pop locations, in other industries. Distribution is special in that way.
Yeah, I agree. Talk to me about the pricing power that Ferguson has, if any. What is Ferguson's pricing strategy? And do you think they have any pricing power? And would you describe the pricing in the industry as rational?
The rationality of pricing varies by submarket. So PVC piping is going to be kind of volatile, right? They don't have a lot of control over things like that, but they've got more control in other parts of the market. Their ability to hold 30% gross margins over time is testament to the idea that they can pass through power. I mean, that's pricing, and that's what distributors do, right? They're passing through to the end customer, and if they can't do that, they're not going to have a very durable business, right? Because they're losing margin. I do think they have pricing power in the sense that they are creating value added services. So I do talked about some of those value added services: inventory management, making sure things are on time, making sure they have things in stock. Those are things that are not easy to do. And so Ferguson won't compete on price. They're not going to try to undercut everybody in the market, but they are saving their customers time. Again, tradespeople, they get paid based on how quickly they turn over their jobs. They want to finish their jobs as fast as possible, move on to the next job. They don't want to wait around. Waiting around to save $100 is not worth their time. So there is some pricing power there, where if they can deliver, be reliable, deliver things when they say they're going to deliver them, do maybe some extras, some inventory management, they can win business away from even national competitors just by having that extra service quality to it.
Yeah, that reliability, that trust. Please discuss Ferguson's management team. How would you rate the management team?
I think it's a very good management team. I would say that they're certainly paid well, so I don't want to discount that. But I think they are also intrinsically motivated to do the job. And what I mean by that is they live, eat, and breathe this business. Even Kevin Murphy, the CEO, he's been with the company since 1999, when Ferguson acquired his family's pipe and supply company in Virginia. And so this is in his blood, really. I mean, this goes back, to his father running the business. And so if you look at the other managers and the named executive, pretty much without an exception, they've all been with Ferguson for about 20 years, or they've been in the industry for 20, 30 years. So, if you're thinking about solving problems in downturns in the market, you want folks like this in charge, because they're the ones who are going to be up at 3:00 in the morning thinking about, maybe we need to pivot the strategy this way, or, how did we do it during the last recession? There's a lot of institutional memory that is present in the management team that makes it extremely valuable.
Yeah, and like you said, they've lived through it. They have that experience. So
Right.
yeah. Can you talk about capital allocation? How does Ferguson allocate its free cash flow between paying down debt, dividends, and share repurchases? Let's save acquisitions for a later question.
Mhm. So from an acquisition, or excuse me, from an allocation standpoint, they are pretty balanced. That is again what Ferguson is and what it does. So their dividend payout has historically been about 40% of earnings. And so the rest of it goes to share repurchases. And they typically finance their acquisitions with debt and then pay that debt down over time. So the repurchase can be flexed a little bit more obviously than dividends. And so if they're paying down their debt from an acquisition, maybe they'll pull back on share repurchases. But they've been a consistent repurchaser especially since they moved to the US market.
You said they had a 40% payout ratio. Do you know when they initiated the dividend and how fast that dividend has grown over time?
The dividend stretches back. I mean, that's one thing about being a UK based company is they love their dividends in the UK. Yeah, I lived and worked in the UK for a year and ran a dividend newsletter there, so I'm very well aware of the passion for dividends. So the dividend has been around for a very long time. They've paid a pretty generous dividend. I don't know that it's fair to think about their pre-financial crisis dividends. I can't recall off the top of my head if there was a dividend cut
Mhm.
during that time. I wouldn't be surprised if there was, but their dividend has grown at a steady pace over the past 10 years.
Very nice. You've also written that, quote, acquisitions are a big part of the Ferguson investment case, end quote. So please talk to us about Ferguson's acquisition strategy and how you rate them with regards to M&A.
From an M&A perspective, it's a pretty straightforward playbook where they're looking to acquire, get into new locations, get into new end markets, get into new technology perhaps that they don't currently have, and then distribute it across their network if it's a technology that or a product that they can sell. And so they want to their goal is to add about 1 to 3% per year in revenue from acquisitions. Uh, what I've heard is that they typically add about 300 to 500 basis points to gross margin when they acquire a mom and pop. And so they typically acquire them for about 1 time sales, thereabouts, and Ferguson trades for about 1.3 times sales. So they get a natural uplift in valuation. So their return on incremental invested capital is pretty good. I don't think that they necessarily are Danaher level quality for M&A, but I do think they're very good at M&A. So that's not a major concern of mine. I don't think they're going to make an extremely large acquisition. My guess is they're going to stick with their playbook of doing these tuck-in acquisitions and adding value to their network that way.
Very nice. You also wrote that Ferguson's corporate governance is, quote, squeaky clean, unquote. What do you mean by squeaky clean? What aspects of its governance do you admire? Is there anything about its governance that you think needs improvement?
Coming from the UK, they tend to have a stronger, I guess, traditional governance approach. So the UK has a governance code, like most developed countries do. The US being the prime example of one that does not have a governance code. And the reason for that is that US corporate law is dictated by the states and not at the federal level. So most jurisdictions around the world are federally. The corporate law is federal or at the state level. So they the governance code applies to all companies in the UK. Ferguson, for example, has a split chair and CEO role, whereas a lot of the S&P 500 companies do not. So they have a split chair CEO role, which I think is important. If you think about just the mechanics of a board meeting, the chairperson sets the agenda, sets the conversation, and when the CEO is the same person, are you going to be able to speak freely? And they've said they've got a independent board, they've got a diverse board. The board, the remuneration policy is very fair, and it's based on metrics that would matter to shareholders. So that reduces the principal agent problem. So they're working towards metrics like EPS and return on capital employed that should matter to shareholders. So that all works well. So it seems like it's a very well functioning board. If I have one issue, and it's not major because the company's, like you said, $50 billion of enterprise value, is that management doesn't own a ton of stock collectively. But again, it's a huge company, and you typically don't see
Yeah.
people with more than 1% when you've got a $50 billion company.
Yeah, definitely. So I think a debate among investors, not only for Ferguson, but for a lot of companies that experienced a pull forward in demand during COVID and lockdowns when everyone was working from home, centers around whether some companies were quote unquote over earning because of the accelerated top line growth. Ferguson's operating margins or EBIT margins were around 7% pre COVID and expanded to nearly 10% at the high in 2022. Where do you land on this debate? Do you think margins will revert to pre-COVID levels, or do you think it can sustain higher normalized margins going forward, and why?
That was certainly the concern when the stock was selling off earlier this year, was that the construction market's going to cool, PVC prices have come down, commodity prices, and then so you're going to have this drawdown in the margin profile. And it wasn't quite clear, is it going to go back to 7, or is it going to moderate somewhere? And management this past quarter, the stock had a huge boost because it showed that it was moderating and that it wasn't going back to 7%. But there was certainly this pull forward. If you think about not just from a commodity price inflation standpoint, if PVC doubles in price, it doesn't have a 1-for-1 price increase or cost increase for Ferguson. So that drives their margins higher when they sell that product through their channels. But at the same time, you also had people who were home during COVID using their homes more often, maybe remodeling, changing the kitchen, maybe adding a bathroom, remodeling the bathroom, maybe pipes break because they're being used more, HVAC breaks because used more. So there was a lot of pull forward. And so I think what we saw in the past 18 months or so was a destocking of that and a reset. And they've done a great job controlling their costs. I mean, the gross margins didn't change much. I think they've right-sized what they were working on. And they're concurrently making these investments in their distribution centers as well, which was adding to SG&A. And now that's slowed a bit. And so we're getting to a more moderated operating margin. So I think they're about 8.5% right now. But the long-term goal is to get to that 10%. And I think they're going to. I think they are because they also have things like their private label, which is about 10% of the revenue, and I believe their gross margins are about double what they typically get on that. So as that takes a larger share over time, that will support. Again, going back to those, the bargaining power that they're going to have with national accounts, these mega projects will be useful to them as well. So I think that will. And then again, going back to the dual counters, you're looking to maximize the utilization rates of those stores. And so as more volume comes to those stores, that should be a natural uplift to margin.
Yeah, definitely. Where do you think future organic revenue growth will come from? So what are the opportunities for revenue growth going forward? And in your opinion, what is the EPS algorithm over time? So if you can build us a ladder right here on the show, and then you add your estimates, rough estimates for organic revenue growth plus acquisitions. I think you said they like to add 1 to 3 percentage points from acquisitions, plus margin improvement if you think there's any, which I think you said maybe they could get back to 10%, plus buybacks. Where do you land over time for rough estimate of EPS growth going forward?
Management's estimates or its medium-term target for revenue growth about 3 to 5% from market growth, just general. And we'll talk about this tailwinds. And then they want to take another 300 to 400 basis points of share each year, and then have 1 to 3% from M&A. So anywhere from 7 to say 12% it's pretty wide range. I think they're probably more likely to hit 7 to 9%. A lot of
that's for revenue. That's for
revenue.
Line. Yep.
For revenue.
Yep.
And so you add in a little margin, you add in some buybacks. I think they're mid double digit or mid teens, I should say. EPS growth is where I would expect them to fall out over time, if they're able to execute on those things. And again, a lot of it has to do to the success of the underlying markets that they're in. We talked about some of them a little bit about water infrastructure needing to be replaced. seems like that's going to be one of those inevitable. It just has to get done. If some, again, these mega projects, especially if you expect more data centers, other mega projects like of that size occurring over the next 10 years, that will also generate more revenue for Ferguson. You and I've talked about this with new homes. We're underbuilt. We're going to need new homes being built in the U.S. and they need plumbing, they need waterworks. So again, I think you in order to own Ferguson, you have to really believe that we have to build in this country.
We have to build, yeah.
And if you don't believe that, you shouldn't own Ferguson because
Right.
it'll be too expensive right now. But if you believe that we need to build in this country and that Ferguson can capitalize on those opportunities and take share, the current valuation, which is currently about, I think, $225 a share, thereabout, as we're speaking, is a fair price.
Yeah, I agree. And I'll say my clients know that a big theme in the portfolio I manage is that we need to build. In my opinion, we need to build in this country. So that is a big theme in the portfolio I manage at Bastion. You mentioned the CEO, Kevin Murphy, came to Ferguson because his family's company was acquired like over 20 years ago, I think. So is there anything that stands out to you about Ferguson's corporate culture?
What I've picked up on is that when compared with other distributors and other competitors, whether it's Home Depot or Lowe's, Ferguson's known for having experienced professionals at the counter. So if you're a plumber and you're going to the store, it's not somebody who's never worked in plumbing before getting your parts for you. They can sit down and actually talk with you about your project, what you're working on. Have you tried it this way? Have you tried it that way? So there's a real strong customer service component to it. They have their stores are corporate owned versus some of their other competitors, which may be franchise. Like Wind Supply is a big competitor of theirs that is as a franchise model. And so when you're a franchise model, you are reliant on those franchisees to have the same quality demands that you want at the corporate level. And Ferguson has that long history stretching back 60 years now of customer service. And so having those relationships, again, multi-generational in some cases, really helps. And so the customer service, I would say, is the corporate culture that kind of runs through the business.
It's funny because that was a part of the culture when we spoke last time on this show for Old Dominion as well.
Right.
The customer service, yeah. So maybe a curveball question of sorts. So why do you think Fastenal and Grainger have such higher margins than Ferguson? So Ferguson's gross margins, you mentioned, pretty consistently around 30%. But Grainger's gross margins have recently been in the 38 to 39% range. And Fastenal's gross margins are around 45 to 46%. Is it just the nature of the products? Do, fasteners and nuts and bolts and studs and washers and pumps and hand tools and safety equipment just carry higher gross margins than plumbing and HVAC supplies? Or do Fastenal and Grainger sell a larger portion of private label brands? You mentioned that Ferguson is trying to grow their private label brands. Or is it something about the go-to market strategy or the competitive dynamics that can explain the large difference in gross margins? So a bit of a curveball. I'm asking it because I think it can help our listeners understand that different types of products can carry different margins, but also that the different ways of selling a product can carry different margins. For example, competitive bidding on larger projects versus selling small replacement parts from an on-site vending machine.
I think you touched on a lot of the issues or that explain the difference in gross margins. I think at the core, think about how many levels there are to the end customer. So for example, with Fastenal, you mentioned the vending machine. So they're typically on site working with the customer who's going to create the product and then sell it to their end buyer. So if they're working with GE Aerospace here in Cincinnati, and I know there's a Fastenal center there, and they're making a jet, right? That's going right into the machine, and the OEM is going to set the price and sell it to the customer. The issue is with Ferguson's end markets, they're typically working with a contractor who then has to have his or her own markup to sell to the consumer. So if you have a situation where, say, Ferguson buys a water heater for $700 and sells it to their customer for local plumbing customer for $1,000, well, that contractor needs his own markup. And so he's got to then sell to the homeowner for $1,300. Whereas, and so that's the classic middleman issue, I guess, right? Where, ideally Ferguson would deal directly with the end customer, but then you've got the sort of the person installing things, which is a whole separate type of business. So I think that's the issue, is that they're working with customers who then need to set their own margins, to the customers who are price sensitive, more price sensitive than, say, that, an airline might be for a Boeing jet engine. Right. So you've got homeowners who are getting competing bids. You've got a lot of different mom and pops out there who are competing on price. So they have to be, so that they can't be quite as aggressive with price, right? They have to be conscious of, okay, what is the end consumer going to be willing to pay for this, right? And try to negotiate prices that way. So I think that is at the core the major difference between why Fastenal is able to generate 50%. I think you also touched on the fact that they're selling nuts and bolts, right? Which is very simple type, less than a cent each.
Right.
So those margins do add up that way too. But I do think it's also due to the fact that they have another layer in between.
Makes sense. Closing up here, why moat business? You really admire the management team. You think the moat could be getting wider at Ferguson. So before we close, can you please review what it takes to win as a distributor, and which of these winning qualities do you think Ferguson has?
If I were a wannabe competitor in this space, I would study Ferguson up, left, right, and center, right? I would be trying to figure out, how did they do this? Because no one else has seemed to be able to do it. You think about Home Depot tried to get in distribution and failed. They're trying again.
Mm-hmm.
And so you've got all these other folks who have been trying to move into their markets and failed. It's a complex system. Managing all of these SKUs to be as diversified and balanced as they are is a real challenge. Just again, going back to
a million different products, I think you said.
They've got thousands of millions of SKUs. I mean, it's a huge inventory. You think about going down the Home Depot, plumbing aisle, all the different SKUs they have in just one aisle.
Right.
But think about what an industrial distributor has to have, given different project sizes. So it's a massive logistical operation to run, and then to add the service layer on top of that, it makes it really challenging. Is to make sure that my customers are satisfied, that I'm delivering things on time, that I have the SKUs in stock where they're needed, when they're needed. That's not a simple thing to do. And so I think Ferguson has shown that it's been very successful at doing that. It's able to use that cash flow to, again, return value to shareholders and then fund acquisitions that make it even tougher to compete against. So I think it's really tough to compete against Ferguson, not just locally, but increasingly nationally. I think it's going to be a real challenge for even established players to match up with them.
Is there anything we missed? Anything else we should touch on?
We touched on the private label. That's something that hasn't been talked about.
Mm-hmm.
It's about 9-10% of revenue and growing. So that's a higher margin business. It also keeps their suppliers in check in terms of pricing. So if they're trying to raise their prices, Ferguson could say, hey, we can make that too for less, and so give us a better price. So their bargaining power over suppliers is strong. So I think that's something I would maybe think about, is their ability to sell into a wide customer base. And that's what I really like about distributors, the type of distributors that have a fragmented supplier base. So no supplier accounts for more than 5% of Ferguson's supplies, and then over 1 million customers, and no customer accounts for more than 1%. So so they're sitting in a great position, bargaining power wise, between their customers and their suppliers. Whereas if you might have, some distributors have 2 or 3 suppliers, or maybe even 1, and then the bargaining power there can be questionable, because what happens if their supplier decides, we don't want to work with you anymore, right? So Ferguson is much more diversified, and I think that's a really nice position to be in from a distribution model.
Yeah, if there was a theme of this talk, maybe it's the balance and diversification of their business model.
That's right.
Between residential, non-residential, between new construction and repair and remodel. Geographically, I think you said 1,800 branches almost. Fragmented industries, fragmented supply base, fragmented customer base, and they sit in the middle and they add the value-added distribution services.
Exactly right.
Yeah, Awesome. Todd Wenning, thank you so much for part two. Thank you for your time and your knowledge. And this has really been wonderful.
Thanks, John. Appreciate it.
Bastion Fiduciary is a fee-only SEC-registered investment advisor. This podcast is for informational purposes only and should not be relied upon as a basis for investment decisions or personalized financial, tax, or legal advice. It does not constitute either explicitly or implicitly any provision of services or products by Bastion. All statements made regarding companies or securities are strictly beliefs and points of view held by Bastion or podcast guests, and are not endorsements or recommendations by Bastion to buy, sell, or hold any securities. Clients of Bastion or the host or guests of the podcast may maintain positions in the securities discussed in this podcast.